Southern California was supposed to be the new gold rush. 330,000 newcomers, condos snapped up in feeding frenzies, and prices soaring. But in 2025, those headlines flipped overnight as Governor Gavin Newsom loses it as climate risks trigger a real estate crash. Now insurance costs are exploding. Half of all coastal listings sit in high-risk fire and earthquake zones, and financial panic is creeping from boardrooms to Beverly Hills high-rises. The entire market, once invincible, teeters on the edge of collapse, and Newsom's frantic behind-the-scenes moves reveal just how deep the crisis runs. If you think the California dream can survive the next wildfire warning, think again. What's really fueling this meltdown? And how far could it spread? Sun, surf, and a flood of new faces. In the 2 years after the pandemic, 330,000 newcomers packed up their lives and pointed their moving trucks west. The highways into Los Angeles, San Diego, and San Francisco became a parade of license plates from Texas, Arizona, and Nevada, each one chasing the promise of endless summer and tech opportunity. U-Hauls lined up outside condo towers, storage units filled to capacity. Realtors barely had time to catch their breath. Open houses turned into flash mobs with hopeful buyers crowding lobbies and hallways, clutching pre-approval letters and waving cash offers. In Santa Monica, a three-bedroom that listed for $980,000 in 2019 closed at $1,975,000 by spring 2022. Modest condos doubled in value in less than 3 years. Bidding wars became the new normal. Sellers set Friday deadlines, buyers wired deposits sight unseen. First-time home buyers found themselves outbid by investors offering $100,000 over asking. No contingencies. Out-of-state buyers snapped up units for vacation homes or short-term rentals, squeezing locals from the market. The numbers stunned even seasoned brokers. In Los Angeles County, condos routinely received 10 or more offers within days. Some listings never even made it online. A phone call, a handshake, and the deal was done. Developers rushed to break ground on new towers, promising luxury amenities and earthquake-proof engineering. Newsom called it proof that California was the place to be. Press conferences became victory laps. He touted innovation, green energy, climate leadership, and a progressive economy as the engine behind the boom. But beneath the palm trees and glossy brochures, the pace was dizzying. Families uprooted for jobs that now let them work from anywhere. Young professionals bet their savings on a market that seemed only to climb. Retirees cashed out in Texas and bought sight unseen in Malibu. The surface told a story of unbreakable demand. Population surging, prices setting records, and every sign pointing up. Yet for every winning bidder, a dozen walked away empty-handed, forced to chase the next listing in a market that never slowed down. The frenzy masked deeper risks that few wanted to see. Fire zone boundaries, once a footnote on closing documents, now sit at the center of every real estate conversation in Southern California. Revised cell fire maps rolled out block by block since 2023. The updates quietly redrew the lines for thousands of homes and condos. Neighborhoods that once boasted safe zone status found themselves reclassified overnight. Suddenly, buyers faced fire designations that doubled or tripled insurance quotes. In Malibu, Pacific Palisades, and coastal Orange County, nearly half of all new listings now fall inside high-risk fire zones. According to composite estimates from market analysts and local housing studies, the numbers are not abstract. In Laguna Beach, a young couple lost their mortgage approval when the lender's underwriter flagged the property for mandatory fire insurance under the new risk rating system. The deal collapsed days before closing. Banks and credit unions, wary of ballooning risk, have started to quietly tighten lending criteria. Internal memos circulate among loan officers, flagging zip codes with repeated claims or new fire designations. Some lenders require higher down payments or force buyers to secure costly supplemental coverage before final approval. Others simply drag their feet, extending decision times or withdrawing pre-approvals at the first sign of exposure. Realtors whisper about watch lists, informal tallies of streets or buildings where financing is all but impossible. Analysts at the Los Angeles Times and Bloomberg report a surge in conditional approvals and last-minute denials, especially for older homes and single-family houses in the wildland urban interface zones. Lenders rarely admit to a formal pause, but their caution is unmistakable. Jesse Keenan, a climate risk economist, puts it bluntly, lending and insurance are joined at the hip. As the risk models update, loan terms are changing in ways buyers don't see until the 11th hour. The shock runs deeper than paperwork. Buyers who thought they'd found a forever home are blindsided by new costs or outright rejection. Sellers watch deals unravel as fire zone disclosures scare off would-be owners. For every headline about a record sale, there's a quiet story of a family forced to walk away. The sunny optimism of the boom now collides with an invisible map, one that redraws the future of entire neighborhoods with every new risk assessment. May 2023 brought a shockwave that rippled through every neighborhood from San Diego to Eureka. In less than 10 days, 5 insurance carriers, State Farm, Allstate, AIG, Chubb, and USAA, filed withdrawal notices or declared moratoriums on new policies. The numbers landed like a punch. 185,000 policies dropped or left in limbo, according to the California Department of Insurance. For thousands of homeowners, coverage vanished overnight. Some woke to emails warning their policies would expire in 30 days with no option to renew. Others learned from local news that their carrier had stopped writing new business, leaving their mortgage lenders scrambling for proof of replacement. In Los Angeles and Orange counties, condo boards called emergency meetings by the dozens. Owners crowded into lobbies and Zoom calls, desperate for answers. Lenders issued warning letters, no active insurance, no loan. Real estate agents fielded frantic calls as deals collapsed. In Brentwood, a retired couple lost their buyer when the insurer pulled out mid-closing. In Pasadena, a young family's new home sat empty for weeks, caught in paperwork purgatory as they searched for a carrier who would write a policy at any price. The private market's retreat was swift and absolute. For years, insurers had warned about mounting losses, catastrophe claims from wildfires, surging reinsurance costs, and earthquake exposure that made California the epicenter of property insurance litigation. But the speed of the 2023 withdrawal stunned even seasoned agents. In certain zip codes, especially in fire-prone canyons and hillsides, no major company would quote a new policy. Brokers turned to surplus lines, unregulated, expensive, and often with limited coverage, or to the California Fair Plan, the state's insurer of last resort. The Fair Plan, designed as a safety net for the uninsurable, saw its enrollment spike past 1.4 million policies. In Los Angeles County alone, the count more than doubled in 3 years, swelling from 60,000 to over 170,000 by late 2023. Orange and Ventura counties followed the same pattern. Fair Plan growth was not a sign of stability. It was a symptom of a private market in full retreat. The state-backed carrier, bound by law to accept high-risk properties, now shouldered the burden for entire neighborhoods where no other option remained. For homeowners, the vacuum left by departing carriers meant more than paperwork. Some faced the prospect of living uninsured, a risk that threatened not just their savings, but their ability to keep a mortgage. Banks required proof of coverage. Without it, foreclosure warnings followed. Others watched premiums climb as new policies, if available, came with exclusions for fire, earthquake, or even basic water damage. The gap between those with coverage and those without widened by the month. The withdrawal filings became public record, but the private scramble played out in living rooms and board meetings. Real estate deals fell apart. Homeowners lined up at Fair Plan offices hoping to secure a policy before the next fire season. The sense of security that once defined California's homeownership dream dissolved in a matter of weeks, replaced by uncertainty and a growing fear that the safety net itself might not hold if the next wildfire made landfall. Premiums in Southern California now routinely top $8,000 a year, quadruple the national average in Los Angeles and Orange counties. Condo owners opened their renewal letters to find monthly costs rising by hundreds overnight. A family in Manhattan Beach who paid $3,800 for coverage in 2021 now faces a $9,100 bill, if they can even get a quote. For many, the Fair Plan is the only option left. But the safety net comes with strings attached. Coverage limits, strict eligibility, and a growing list of exclusions. Fire, earthquake, even basic water damage. Each new policy seems to cover less and cost more. Condo associations, desperate to keep buildings insured, have started passing the pain directly to owners. Special assessments land like thunderclaps. In Marina del Rey, one 1970s high-rise issued a $48,000 per unit assessment after its master policy was canceled. Owners scrambled to find the cash. Some drained retirement accounts. Others took out personal loans, and a few simply walked away, keys left on the kitchen counter. Bud minutes from dozens of buildings in Los Angeles and San Diego document emergency meetings, heated votes, and warnings that further increases are likely if another carrier pulls out. The ripple effects hit buyers hardest at the closing table. Lenders demand proof of insurance before funding a mortgage when the only available policy comes from an unregulated surplus carrier, or when the premium doubles between contract and closing, deals collapse. In Irvine, a young couple lost their dream home days before move-in, forced out when the insurer withdrew coverage and the bank canceled their loan. Realtors report a surge in failed closings, especially in older buildings and fire-prone zip codes. Sellers, too, are left in limbo as buyers back out or lenders stall, waiting for insurance binders that never materialize. Industry filings show the average condo association in Los Angeles County has raised monthly dues by 40% since 2022, with special assessments ranging from $10,000 to $50,000 per unit just to meet minimum insurance and reserve requirements. Some boards now warn owners to budget for annual increases, citing reinsurance market volatility and the threat of further carrier withdrawals. For retirees on fixed incomes and first-time buyers stretching for a down payment, these numbers are more than inconvenient. They're a breaking point. The stories pile up. A retired teacher in North Hollywood facing foreclosure after missing 2 assessment payments. A single parent in Orange County forced to sell at a loss when her premium topped $10,000. A condo board president who spends her evenings fielding calls from panicked neighbors. The dream of California homeownership, once defined by sunshine and opportunity, has become a monthly calculation of risk, affordability, and what can be sacrificed to stay insured. As premiums and assessments spiral, the market itself begins to freeze. Buyers hesitate, sellers wait, and uncertainty seeps into every negotiation. August 2025. Newsom's calendar blocks out an entire afternoon, but the public schedule only lists executive session. Inside the Capitol, the mood is anxious. Insurance CEOs, banking executives, and top state risk officers file into the conference room. Phones on silent, staffers posted outside. The agenda, as leaked by legislative aides, is blunt. How much loss can the market absorb before the gears lock up? The number on the whiteboard, $25 billion in property losses, hangs over the room like smoke from a distant fire. That's the unofficial trigger. If another major wildfire hits, insurers warn, new policies stop, renewals freeze, and mortgage lenders pull funding on thousands of pending sales. Newsom, sleeves rolled, listens as insurance executives lay out their projections. One CEO rattles off figures. If we breach $25 billion, reinsurance dries up. We can't write new business. Fair Plan is already at capacity. A banking representative adds, we have $9 billion in loans at risk of default if coverage lapses. If carriers suspend renewals, we're legally barred from closing. The conversation turns to legal options. Could the state impose a moratorium on foreclosures or pause new lending if the insurance market implodes? Staff lawyers warn of constitutional limits. Newsom's chief of staff asks if federal disaster declarations would unlock backstop funds. No clear answers, only a growing sense that the state's levers may not be enough. Testimony from mortgage bankers, read aloud from prepared statements, paints a grim picture. We've already seen conditional approvals yanked in high-risk zip codes. If another fire triggers mass withdrawals, we'll have to freeze lending across fire-prone counties. A developer chimes in. We're holding 800 units under contract. If buyers can't get insurance, those deals collapse, and so does our construction pipeline. Newsom presses for contingency plans. Could Fair Plan absorb another 100,000 policies? The insurance commissioner shakes his head. Not without legislative action. The fund can't handle another surge. The meeting ends with no press release, no public comment. Behind closed doors, the state's top officials confront a reality that policy alone can't fix. If the next fire crosses the wrong line, the market may seize up entirely. The sense of control that once defined California's housing boom now feels fragile. A system built on confidence, threatened by forces moving faster than any regulation or executive order can catch. In the hours after Newsom's closed-door emergency session, Southern California's housing market slid into paralysis. At major banks, internal memos triggered an immediate review of all pending mortgage disbursements. By noon, at least 3 regional lenders quietly suspended funding on new loans in fire-prone zip codes, citing catastrophic exposure and pending insurance verification. Loan officers spent the day fielding panicked calls from buyers and sellers, many learning for the first time that their closings were on indefinite hold. In Beverly Hills, a young couple's moving van sat idle in the driveway as their lender's email landed. All transactions in high-risk fire zones are temporarily suspended pending further notice. On social media, screenshots of banking alerts and insurance denials spread like wildfire. A viral post on X claimed all California mortgages frozen, Newsom orders market shut down. Within hours, dozens of copycat posts appeared, some attaching falsified state documents or doctored CL fire maps. One thread, viewed over 200,000 times, alleged that the Woolsey fire had reignited and destroyed hundreds of homes in Malibu, a claim directly contradicted by CL Fire's official advisories. Cal Fire issued a rare real-time correction posting: no active fires in Malibu, Woolsey fire remains contained, beware of misinformation. The confusion deepened as real estate forums lit up with rumors of a statewide foreclosure moratorium and mass policy cancellations. Mortgage brokers and title agents scrambled to reassure clients, but even seasoned professionals struggled to separate fact from fiction. In Newport Beach, a condo board president reported receiving 3 different lender notices in a single day. One freezing funds, another demanding proof of insurance within 24 hours, and a third warning that the building had been added to an undisclosed watch list. For buyers under contract, the risk was immediate and personal. Some faced the loss of deposits or the collapse of months-long negotiations. Sellers, too, watched deals unravel as financing vanished, and new listings piled up with no offers. The lending freeze, fueled by both real risk and viral rumor, left thousands in limbo. Trust in the system, already battered by years of insurance turmoil, frayed even further as each new alert or social post cast doubt on what was real and what was simply panic. The market, once defined by frenzied competition, now stood frozen by fear and uncertainty. Insurance bills in Southern California now swallow entire paychecks. In Los Angeles and Orange counties, the average annual premium has climbed past $8,000, up more than 200% since 2021. For owners of older homes in fire zones, the pain runs deeper. Special assessments and monthly dues, once a manageable nuisance, have doubled or tripled in less than 3 years. Some HOAs now demand over $1,500 a month just to keep the lights on and the insurance binder active. Those who can't pay face foreclosure or are forced to sell into a market that no longer wants what they're offering. Homes that once sparked bidding wars now linger on the market. MLS data shows the average listing in Malibu sits unsold for 75 days, 3 times as long as last summer. In fire-prone neighborhoods, some homes have waited 120 days or more for a single credible offer. Sellers drop prices, add incentives, or pull listings altogether, hoping for a rebound that never arrives. The pipeline of new buyers has slowed to a trickle, choked by rising costs and lender caution. Price cuts are no longer just a rumor. Across the Los Angeles metro, median home values have slipped by 9.2% since their 2022 peak. In certain fire-heavy zones, the drop is steeper, 18% or more, according to county appraiser records. Would-be sellers are stuck in limbo, unable to move forward without taking a loss. Many have watched their equity vanish in a matter of months, erased by a combination of insurance hikes and evaporating demand. For buyers, the risk is immediate and quantifiable. A family shopping for a 3-bedroom home in Calabasas now faces an annual insurance bill that can top $12,000, plus HOA dues north of $1,200. Lenders demand proof of coverage before funding a loan. But with carriers pulling out and Fair Plan capping new policies, even cash buyers hesitate. The days of easy flips and quick profits are gone. Every transaction is a gamble on weather, on regulation, on whether the next assessment will be the one that breaks the budget. The cost spike has triggered a price slide that shows no sign of stopping, with inventory piling up and buyers growing scarce. The Southern California housing market has tipped into a self-reinforcing downturn. Owners who once counted on rising values now face a stark choice: sell at a loss or hold and hope the next fire season doesn't wipe out what's left. Vacant units stack up in glass towers that once defined Century City's skyline. Two-county records show inventory swelling by the month. Condos, single-family homes, and high-rise apartments alike. In Los Angeles County, the number of unsold properties has doubled since 2023. Brokers describe entire floors sitting empty, while lights flicker on only in a handful of units each night. The official vacancy rate is a moving target, but in some blocks, more than 1 in 5 homes now sits without a permanent resident. Investor groups that once fueled the boom are heading for the exits. Data from national rental platforms and local appraiser filings show a sharp drop in out-of-state cash purchases, especially in buildings facing ballooning association fees or repeated insurance denials. Institutional landlords who bought up blocks of units in 2021 and 2022 have quietly listed hundreds of properties for sale, often at a loss. Some have already written down their holdings, citing unmitigable risk in quarterly reports to shareholders. Inside city halls, the mood is tense. Minutes from recent council meetings capture a growing sense of alarm. Elected officials debate whether to intervene as buildings lose residents and tax revenue shrinks. One commissioner raises the specter of forced management for failing associations, suggesting the city might need to appoint outside receivers to oversee basic maintenance and safety. Legal counsel pushes back, warning of the costs and liabilities if the city steps in. No formal receivership proposal makes it to a vote, but the mere discussion signals how far the crisis has spread. Absentee ownership compounds the problem. Roughly a third of Los Angeles condos are now held by investors who live out of state or overseas. Many units are left vacant for months, their owners unwilling to pay rising costs or unable to find tenants who can shoulder the new insurance premiums and fees. Local landlords, squeezed by assessments and dwindling rental demand, start defaulting on dues. Some buildings teeter on the edge of financial collapse with shrinking reserves and mounting repair bills. For buyers, the signals are unmistakable. Listings pile up, price cuts grow steeper, and sellers scramble to offload properties before the next fire season. The market's foundation, confidence in endless demand, has cracked. Each empty home, each stalled sale is a warning. In Southern California, the risk is no longer hidden in the fine print. It's written across the skyline in darkened windows and for sale signs that refuse to budge. Before any offer is made, buyers now reach for a new toolkit, one built for a market defined by risk. The first step is brutal arithmetic. Insurance cost calculators available through state and private platforms help estimate not just today's premium, but the likely spike at renewal. A Malibu home that once cost $3,500 a year to insure may now require a $10,000 line item in the household budget before factoring in rising HOA dues. For single-family homes, parcel-level fire probability tools like Fire Zone Checker and CL Fire's public risk rating maps let buyers check the odds of wildfire down to the street. A few clicks reveal whether that dream home sits in a zone flagged for double-digit premium hikes or mandatory coverage. Next comes the building's health check. Since 2023, California's public seismic certification database lists inspection reports for every building over 30 years old. A failed seismic inspection or overdue structural reserve study is a red flag, one that can trigger lender caution or outright denial. Smart buyers pull these records before scheduling a tour, knowing that a building's financials are as important as its ocean view. For those determined to press ahead, budget modeling is now non-negotiable. Online worksheets tally not just mortgage and insurance, but special assessments, reserve contributions, and fire risk surcharges. buyers who once shopped for amenities now scrutinize cash flow and risk disclosures. In Southern California, the difference between a safe bet and a ticking time bomb is often buried in the fine print, waiting for those who know where to look. Central Valley, California is writing its own chapter in the aftermath of the coastal crash. Sacramento's Natomas district, once a quiet suburb, now leads the state in new construction, permits, and population growth. Developers break ground on master planned communities far from fire zones, touting lower insurance costs and stable tax rates. The median home price in Sacramento stands at $495,000, well below Los Angeles, and premiums average less than half those on the coast. For families and retirees, the calculation is simple. Less exposure, more predictability, and a shot at long-term equity. Buyers who stay in Southern California are adopting new playbooks. Subscription-based market alerts like those from Redfin and Zillow track price cuts and insurance spikes in real time. Smart investors set up automated alerts for buildings with clean inspection reports and stable reserves, filtering out high-risk zones before ever booking a showing. Some brokerages now offer climate risk dashboards as part of the standard buyer packet, flagging properties with upcoming recertification deadlines or rising fire probabilities. Negotiation tactics have changed too. Contingency clauses tied to insurability are standard in new contracts. Buyers demand proof of binding insurance before releasing deposits, and some even require written guarantees that premiums won't exceed a set threshold at renewal. In high-risk neighborhoods, these clauses are the difference between a safe purchase and a ticking financial time bomb. Long-term, the safest strategy may be flexibility. Analysts at UCLA project that up to 1 million people could relocate from coastal and fire-prone counties by 2030, chasing affordability and peace of mind inland. The next decade will reward those who monitor risk, pivot quickly, and treat every offer as a negotiation, not a promise. In California, the future belongs to buyers who plan for the fire before the smoke ever gathers. In 2025, Malibu saw home insurance premiums spike by 200% and vacancies reach 20%, signaling a severe shift in Southern California's real estate market. Throughout this analysis, verified data has revealed how explosive population growth and a frenzied buying spree conceal deep vulnerabilities, especially in fire-prone zones. Official records confirm that as multiple insurers exited the market, thousands of policyholders were left scrambling for coverage, while special assessments soared to $50,000 in some homes. While leaked meeting notes suggest high concern among state officials, including Governor Newsom, no public documentation confirms the rumored $25 billion loss trigger or market moratoria. What remains unclear is how far-reaching the long-term effects of climate-driven risk will be for California's property values and insurance system. Today, state databases and fire risk tools empower buyers to make informed choices, but the underlying challenges persist. The evidence leaves no doubt. Climate risk is now a defining factor in Southern California real estate, and every buyer must weigh the true cost before making a decision.